Right, guys, this is the levels education video that I said I was going to do. And I think it's probably one of the most important ones because it's the most easily identifiable. Also, it answers a lot of questions in regards to other, things that you might hear in the trading space thrown out by other traders, to do with their trading strategy, the way they name things as well. I've had a lot of people in the last few weeks ask about, what's the difference between order blocks and POI and all this sort of stuff, even imbalances, right? Um, this is all to do with the levels in the market, i.e., where the banks like to keep price trading within. Okay. Whenever you look at the market on the higher time frame, you can see that price is bouncing between a ceiling and a floor kind of thing. So again, this is to do with the levels, because at the end of the day, when you're looking at a GBP USD, it is basically just telling you what the dollar you would get for your pound if you were to go to the foreign exchange, right? It's that is pretty much it in a nutshell. It is about how much you would get conversion wise for your pounds to dollars. Okay. So 9 times out of 10, the banks like to keep price at a round number. So whenever you heard me talk or say the phrase psychological key level, i.e., looking at the right hand side, this right hand side panel here gives you lots of different numbers. But even here, look, you can see it is in round numbers of 500, 13200, 132,500, 13300. You can see it goes up in stages in 500s, which is 50 pip levels. 50 pips is from 1.33 to 1.335. That's 50 pips. 1.33 to 1.34 is 100 pips, right? That's how you can easily identify the pip count in the markets. Look on the right hand side of the panel, understand that these round numbers are moving in certain pip ranges, right? But this also refers to where price, technically, if you were to go to the foreign exchange, that's where price would be sat at, right? If you go to an exchange rate, you are not going, the price is not going to be sat at 1.36149, right? That's not going to be where it's at. They will keep it at a round number. So it'll probably be 13600 for argument's sake. That's how much you would, they would price it in at. But it's also where you can start to build, on top of things like candlestick formations, market structure, all that sort of stuff, because levels is what market structure comes into as well, because the way that the market is creating its highs and lows will be based off levels in the market. When it gets to a high point and then it starts to retrace down, that's because that high point has hit a level, an area that is, a psychological key level, or an area where price needs to pull back before trying to break through. If you look at imbalances normally happen through breaking through a psychological key level. So when you see a big green bullish candle, that is normally, and you've got a previous high, which it's broken next to it, that's normally price breaking through a psychological key level, right? And then when that retracement happens and it comes back down into filling the imbalance that broke through, that is price retesting that psychological key level that it's broken through, right? So you start to simplify things without having to, think, oh yeah, I need to drop down to this, I need to drop down to that, see all these imbalances and blah, blah, blah. This is why I say to you, you start focusing on the higher time frames, everything becomes a lot clearer. So even if we just take, for argument's sake, right, touch points where prices kind of hit, and we grab a rectangle tool. You can use the rectangle tool if you want. And we just draw an area like this, okay? We look to the right-hand side. That is aligning with 1.3300 flats. So that is a flat level right there. That is a psychological key level due to the fact that it was tested a number of times, right? Yes, it broke through, but it broke back above. That's a solid floor right there, okay? And when I say tested, i.e. it comes back down or goes up, it doesn't need to be to the T. It doesn't need to be smack bang on 1.33. It can be 1.33100, 1.33150 or something like that. Or it can break back below and it be 1.32900. That is just the area of that psychological key level that it has come back to retest. Okay? And then if you look above, where was price hesitating breaking through? Well, 1.3400. So you can go and draw another box above like this, and you can start to see, okay, touch points, testing that area, right? Before it broke through and retested and then come back up, went traded up, came back down, retested, traded back up. And this is where you just start to draw your levels onto the chart, i.e. you're mapping out the next area where price could react from. But, you know, you only really do this when you've had your kind of high placed into the market and then price starts to trend back down, because that there, you know, is a like key level that price is failing to break through or hasn't got enough volume. So this, for argument's sake here, would be, we'd see this high. Let's put in bar replay. Okay, we'd see this high and we'd let price sort of play out, and then we'd start to see price trade down. Okay, so we would then go and put our level on. Again, looking to the right-hand side, 1.3600 flat to the T. Okay, to the T, that hit right before it started trending back down. And it trends all the way back down. Where does it test? 1.34. Okay, so we go, okay, well, this is our new range, right? Because this is what it's doing. It's just trading within a range, trading within levels. Okay, so boom, came back down to 134. Let's see if it goes and has enough volume to break through 136. And it doesn't again. It tests the level and then starts to trend back down. Where to? The mid-level, 134,500. Okay, this is not me saying you need to put in fucking every single sort of 50 pip range level, but understand between 135 and 136, there is a mid-level of 135.5, because remember the 50 pip ranges. Okay, so that is your mid-level. Even if you go and draw some sort of line around 135 like this, you can see that it acts as a little level of, it's like a minor level, okay, in between the major levels. But, you know, realistically, if we draw a line, draw a level between 135, you can see that also acts as a level, okay, where price reacts from before trading up. So this is where I'm saying levels are very important, because I know a lot of people that just trade that, right? They know how to identify trends. They don't need to draw trend lines on, but they are basically just waiting for a level to be broken, retested, and then placing a trade. Okay, and that's as simple as it can be. But the one thing you can't really do is try to identify psychological key levels on things like gold, okay? Every fucking 20, 30 pips can be a psychological key level on gold. This is strictly for trying to identify it on pairs, okay? Start off with a major pair. Euro USD, GBP USD, something like that. Something that is easy for you to start mapping out levels. You know, right now we are up at 136, okay? So I know that at the moment our range is 136 and, you know, roughly 138, okay? So that right there is my trading range for the time being. 138 and 136. We have got the mid level of 137 right there, if you can see. There's 137. So right now, we're subdued but under 137, but above 136. So I'm simply waiting for one or two things to happen. I'm waiting for 136 to be broken, retested, and then to start pushing down. Okay? And just trading off of that is fine. You don't need to be worried, especially with, swing trading and stuff like that. You don't need to be worried about entries on the lower time frame. You are literally just waiting for something like this 4-hour break. Hold on, let me find a better example. A bit choppy, but say for argument's sake here, okay, 13500s. 1300 broke through, right? And we're just waiting for that retest, that volume candle that broke through, and simply just placing a fucking trade, just going, right? Stops can be below this low, and then you can be targeting the highs. Even that is a 1 to 2 risk to rewards, easy trades. Never dealt with any drawdown, but that is just basically trading off the 4-hour time frame, seeing the break of the resistance level and then the retest, and then even if you just wait for some sort of bullish confirmation, boom, you're in, blah blah blah, happy days, right? But this is like the bread and butter. This is your kind of chicken of the meal, right? And all your imbalances and lower time frame confirmations and this, that, and the third, that's all like the veg and the chips. Do you know what I mean? That's like the stuff that's like the icing on top. But levels is like the chicken breast. It's like statutory in your diet. If you are not using levels, then it's very, very hard for you to identify what kind of thing the market is doing or what kind of range price is trading. Because, walking along the street and someone could ask me, where is GBP USD trading within right now? And I'd know, well, 136, 137, that's its range at the moment between those two levels. And, that would be suffice. So, having this mapped out, and it's a very good good for your eyes to identify these sort of things. It's good for you to be able to go, right, okay, market structure is starting to make sense because I'm drawing on my levels. I'm understanding that price is sideways, right? This identifies that price is sideways for this whole kind of 2-3 weeks before it then starts to go on a trend because it broke through 134, which is sideways between. So it's all those sort of things that helps you visually identify. But yeah, I mean, that's as simple as it is. Start to just higher time frame. Do not be worried about looking at this on like the 5 and the 15 because there's all noisy levels, little minor levels in there that you will start getting yourself sort of, screwed up on. Do this on the 4-hour time frame. On whatever pair you trade, can be Euro AUD, it can be GBP JPY, whatever. GBP JPY, the levels are going to be a little bit closer together because the pip range is closer together. But I would start, if I give an example on GBP JPY, GBP JPY's levels are, they've still got the 50 pip range, but you can see if I show you an example, 196 right here to 195 is that big. Okay, that is how big the range is from 100 pips right there. GBP USD, if you look, 134 to 135. It's quite big. It's a bit bigger. That is the kind of 100 pip range on GBP USD. So just be wary of that, but still work within levels of 50. Okay, I think it's surely that, if I remember correctly, it's the same on AUD pairs, Euro AUD, GBP AUD. You know, 17800, 177500, 17700, right? 50 pip ranges for the levels. But you will start to notice that they all, you know, when I first started learning, what did I used to do? I think I used to be quite technical with it. Fuck me, my brain's going. So I used to literally get horizontal tool, right? I would place it on the chart. I would double click, go to the coordinates and literally put it to the T like this, right? And then I would get my rectangle tool and I would draw a level like that. Okay, so visually I've got the 13500 imprinted on the side there. And then I would literally get the horizontal tool again. I would then put it on price 136, and then I would draw my level around, or I'd draw my box around like this. Okay, I'd be a little bit more kind of thinner with the boxes because I know, right, okay, I know the price can react from that level, but you can see, look, visually, it looks a lot nicer. Okay, so start doing that on your chart work and start implementing it into your strategy, and you will start to see things a lot clearer. Market structure will make a lot more sense. But yeah, hope that helped, guys. And I will be making the next educational video next week.